Hi folks, it's Richard from Inclusive Driving. In this video, we will attempt to demystify the concept of tax payment on account, something that generally bites driving instructors and other self-employed folk on the bum after their first decent year. We're going to use simplified round numbers along with some approximations just to make the numbers easy. So here goes. Let's say that on the 5th of April 2021, you add up all the money that learners have given you between the 6th of April 2020 and the 5th of April 2021, and it comes to £40,000. Then you add up all of your business costs, so things like petrol receipts, franchise fees, car washes, cups of coffee, insurance and all that, and find that it comes to £10,000. This means you have made a profit of 40,000 minus 10,000, which equals £30,000. All the big driving schools tell us in their advertising that driving instructors make £30,000 a year, so we'll stick with that fictional amount. Here it is, my £30,000, and for convenience, it's all in £1,000 notes. Now, we are allowed to earn a certain amount of money without paying tax on it. And currently it's a little over £12,000, so let's take that out of the pile straight away and we're left with £18,000. And unless you have some specific circumstances going on, you will be paying tax and national insurance on that £18,000. The way this is worked out is outside the scope of this video, but a reasonable estimate is that your tax bill will be £4,000. And the deadline for paying this is next January. That's 10 months away. So do not spend that £4,000. Put it somewhere safe, like under your mattress or in a Tupperware box buried at the end of the garden. Or, if you're sensible, put it in a no-risk investment for 10 months to earn some extra money, which of course you'll also get taxed on later. Now, it's January 2022. And it's time to pay your first tax bill. So let's take our £4,000 out from under the mattress and burn it, because we'll never see it again in the form of cash. That money has now gone to the Treasury to fund things like schools, roads, nuclear bombs, hospitals and lockdown parties at Downing Street. But the tax woman wants more from you. She's already waited from April 2020 to January 2022 without getting any money from you. She does not want to wait another year before getting her hands on your cash. She wants you to start contributing towards next year's tax bill now. So she will assume that next year you'll make the same amount of profit. So this payment on account will be estimated from your current figures. So in January, as well as handing over the £4,000 you sensibly put on one side, she wants you to pay half as much again. We need to find another £2,000. So actually, we're paying £6,000 from our £18,000 profit. But whereas the £4,000 was initially under your mattress and you could exploit it for 10 months, this extra £2,000 has to be placed under the taxwoman's mattress. It will be in an envelope with your name on, but it's not yours anymore. And 6 months later, in July, she'll need you to put another 50% or £2,000 under her mattress. Now, of course, during this time, you're still working, so there is income coming in at the same time as it's going out to the taxwoman. But effectively, at the end of your first profitable year of self-employment, and remember your first year may not turn out as much profit as you expect, you will pay 2 extra on-account payments towards the following year's tax bill. At the end of the next tax year, the taxwoman will take the money you stuffed under her mattress and give it to the Treasury to spend on policemen, smart motorways and reprinted copies of the Highway Code. The process continues, effectively depositing money every 6 months under the taxwoman's mattress in advance of each tax bill. But it's the first year that sees you paying double. After that, it kind of evens out and you're just paying in advance instead of in arrears. And that continues until you retire or die, whichever comes first.